Hi everyone, and welcome to Q&AMP Live with Shane Oliver. Before we begin, I'd like to make an acknowledgement to country. AMP acknowledges the traditional custodians of lands, waters and communities throughout Australia. We pay our respects to the traditions, ancient protocols and cultural practices of Aboriginal and Torres Strait Islander peoples who have lived and cared for country. We extend that same respect and recognition to the elders of this land, both past, present and emerging. So welcome everybody. My name is Andrew Rowe. I am AMP's Chief Client Officer. AMP is in a unique position to support our clients across their life, whether it's helping them save, helping them with their first home, through to supporting them in retirement. It's not surprising right now given the impact of COVID-19, but our recent research shows that Australians are feeling increasingly financially stressed, and managing debt is a large component of that. This is why today we're really pleased to have Dr. Shane Oliver join us to talk to us about the impacts of COVID-19 on the property market now and into the future. Just a little brief on Dr. Shane Oliver. So Dr. Shane Oliver is AMP's Chief Economist and Head of Investment Strategy of AMP Capital. He has been at AMP for over 35 years and is sought after for his economic and investment market updates. Shane is a regular face on Australian TV and engages regularly with investors at public events and forums. As Shane is going through his presentation, I really encourage you all to ask some questions via the Q&A section at the right-hand side of your screen in Microsoft Teams. I will moderate these questions and come back to you at the end of Shane's talk, and hopefully we'll have a really good dialogue going on the back of some of the things you've got raised and asked questions you've asked. So that's it from me. So welcome, Shane. Over to you for the next 30-35 minutes.
Okay, thank you, Ant, and thank you for that introduction, and thank you everyone for dialing in. Please excuse, there's a bit of buzz going in the background. One of the downsides of working at home is that you get this noise and there's a leaf blower going. I think it is anyway. That should soon end, I hope. But anyway, what I thought I'd do today is quickly run through how the global economy is progressing, how the Australian economy is progressing, and then spend quite a bit of time on the property market outlook. So what I'm going to go through is a bit of background here. If we move on to the next slide, which shows the disclaimer, and as you can understand, I'm not a financial planner. What I'm providing here is general information. If you do want financial advice, you're encouraged to see a financial planner. I can't provide you with that. I'm giving you a general overview as to how I see things regarding markets, particularly the property market. So if we move on to the next slide, this is a photo I took. It's on the side of the building. It partly explains why I've been at AMP for 35 or almost 37 years. I was motivated by that motto, which says amicus certus. Full saying in Latin is amicus certus in re incerta. Hopefully I've got that right. But basically means a sure friend in uncertain times. So that's something that's motivated me for many, many years and impressed me about AMP. I know there's been a lot of negative headlines recently, and those headlines, those stories have made me and many other employees at AMP very depressed and angry to some degree that it could happen. So that's something that I just wanted to get off my chest. It's like the elephant in the room here, but I wanted to assure you that there's lots of people at AMP putting together events like this, doing the very best they can for our clients and our customers, and all those people dialed in today. And we're still here for you. So I might move on to the next slide. Hopefully that blower is about to go away. This does get very annoying, doesn't it? What it shows is share markets. You can see, and I'm not going to go into the details here, that goes back over 20 years. You can see that dip earlier this year at the time of the lockdowns, then a rebound, particularly in the US share market. I put that up because it's a good guide. US share market recovery has been a bit exaggerated because of the tech sector in the US, and of course the tech sector has benefited from coronavirus, as has healthcare, and those two sectors rank very highly in the US, a very big share of the US share market. So that's seen an outsized performance by the US share market relative to other markets. But just bear in mind, the other point is that we are well up from the lows. Markets still seem to be remaining supported, suggesting that there is, I think, a degree of confidence out there that economic recovery is gradually progressing. And if we move on to the next slide, you can see our summary of things. I think we saw a big hit to the economies around the world in the June quarter with the very hard lockdowns. Countries these days seem to be trying to avoid that. I know Victoria is an exception to that. But what I am seeing around the world is a more surgical approach to controlling coronavirus rather than hard lockdowns. So Therefore, I suspect that we're on track for a continued bumpy, moderate recovery. And I think that is the path going forward. It's not going to be smooth sailing, but we are undergoing a recovery. But in the meantime, we've got very easy fiscal policies, fiscal stimulus basically, supporting incomes through the downturn and very low interest rates. So if you want to understand what's going on in the property markets, you've got to understand that dynamic. Big hit to economic activity, that's a drag. And in Australia's case, there's another drag from the hit to immigration, which impacts demand. Against that, though, providing some support, and in some cities, propelling prices higher, are the very low interest rates that mean people can borrow for a lot more cheaply. Thankfully, the blower has gone, so I can relax now. I don't have that buzzing going in my head. So that's something which you need to bear in mind when you think, oh, the share market, the property market is out of touch with reality. We've got the biggest hit to economic conditions since the end of World War II or the Great Depression, depending on which one you want to look at. Just bear in mind, we do have those very low interest rates. And I think that's going to remain. I reckon the Reserve Bank will probably cut again here, probably taking the cash rate down to 0.1%. Not a lot in that because it's only a 0.15% reduction from where we are now. But the really important point is that I don't see a rate hike for at least 3 years because there's just simply so much capacity in the Aussie economy. It's hard to justify a rate hike, and I don't think we will see one. Share markets, I think a bit of short-term volatility we can see there, but I reckon the broader trend will likely remain up. Obviously, uncertainty at the moment in relation to a bunch of things, but Australia to some degree is benefiting from better virus control, better stimulus, and we saw more of that last week in last week's budget, and exposure to China. Bit of nervousness today around coal exports to China, but as long as iron ore is not affected, then we should remain reasonably strong. So let's see what's happening with coronavirus on the next slide. And I'm not claiming to be, go to the next slide. I'm not claiming to be an expert here on coronavirus. I'm not an epidemiologist. I'm just trying to put some facts around things. We did see a big rise in new cases globally. Recently, that rise has slowed down a little bit, mainly because the emerging world has seen a slower rate of increase compared to the developed world. You can see there, BRICS, Brazil, Russia, India and China, the red line, rest of the world, not so bad, but of course, Europe is seeing a resurgence in coronavirus cases. The UK, of course, is part of that, even Canada recently. But if you look at the numbers coming out of France, Netherlands, even Italy, they don't look too good. One thing I would stress, though, is the bottom left chart. This is critically important. Even though the blue line, the number of new cases in developed countries are basically Japan, US, Canada, Europe, UK, Australia, New Zealand. Even though the number of new cases has gone up dramatically, the number of deaths has stayed relatively low. And well below the red line, you can see there, the red line is well below the highs we saw earlier this year. And that's telling us that we're picking up more cases because of more testing. So many more young people are getting picked up and they're less at risk of dying. So that's partly what's driving that rise in new cases. It's more younger people. There's better treatments. Donald Trump probably got the best treatment possible. But I think all those treatments, that combination of drugs and what have you that he was given access to, interestingly, he did not turn to injecting hand sanitizer or disinfectant. He actually turned to experts to get him right, which I thought was an interesting twist for Donald Trump. But in any case, he got the very best there, and that does provide hope for others who happen to get, unfortunately, coronavirus. The other thing is in Australia, we have seen some good news recently. The number of new cases have come right down in Victoria and New South Wales, although unfortunately I note today that it's still bubbling along. Victoria got another 12 new cases. We got another 13 in New South Wales. The rest of Australia, those that have reported anyway, Queensland, Northern Territory got 0. So it's sort of a bit like stuck in a bit of a holding pattern there. I think Victoria will open, but it might be a bit more gradual than originally hoped. Just moving on to the next slide. I'm not going to dwell on this one. I don't know the answer, but there is a lot of progress in terms of vaccines and treatments for coronavirus. Even if the vaccine is, say, 50% effective, like the flu vaccine is, I don't think it's going to be as effective as maybe the measles vaccine was or is. If you combine that with better treatments, then I think the world can continue to open up again. And that, I think, is the path we're going through. But obviously, we've still got a way to get to that point. But if we move on to the next slide, I love this one from Maxwell Smart. Get Smart back in 1965. Apparently they were predicting coronavirus back then. As soon as I saw that slide, I have to go and watch the episode again, which is actually quite hilarious, where they put the cone of silence down, and of course it doesn't work. If we move on to the next slide, which shows business surveys around the world, you can see there that massive collapse. Businesses felt terrible going into early part of this year, particularly around April and May. And then, of course, since then, a very rapid recovery. And that's both particularly in the services sector, which was harder hit this time around, and also, of course, in manufacturing. So that's a positive sign for global growth. And the country that went into this thing first, of course, was China. And of course, it has recovered faster through the June quarter. It saw a rebound. It looks like we're on track for a fairly decent rebound in the US in the September quarter. So it looks like economic activity has returned to some degree. This is important. I live in New South Wales. I'm at home at present. If I get in my car, go down the shops, guarantee you there'll be a lot of cars there, a lot of people doing stuff. If I go down there 6 months ago, back in April, there'd be hardly anyone there. So it's pretty hard to deny that a lot of economic activity hasn't come back. I think it has, but obviously we have a fair way to go. Move on to the next slide. It shows why I think Australia is poised to come out of this better than many other countries, maybe apart from New Zealand. Top left chart there just shows the relationship between the number of deaths per million. We've been running about 35 deaths per million people in the US and Europe and so on. Sweden, it's up around 600 deaths per million people. So we've seen a bigger hit to our economy. Even Sweden, which didn't shut down as much, it's still seen a pretty big hit to its economy, which just shows it's the medical impact which is most important, not so much what governments do. So there's that aspect. I think if we've got the number of virus cases way down like we have, that's a good sign. We can open up with more confidence. Secondly, we've sent a lot more stimulus than other countries. I won't go into that. We saw enough on that on the budget last week. More stimulus, of course, and of course exposure to China. Question marks around that. But I think generally speaking, we are benefiting from higher commodities, higher demand for iron ore and so on. And good luck. So if I move on to the next slide, we're coming into summer, for example, whereas other countries are going into winter. Victoria obviously took a hit. This is payroll jobs as surveyed by the ABS, the Australian Bureau of Statistics. Big hit in Victoria through the latest shutdown there. But other states generally continuing to recover up towards pre-coronavirus levels, although there's still a bit of a way to go yet. If we move on to the next slide, again, relating to Australia, we put together a bunch of economic indicators that come out on a weekly basis. You can see those economic indicators, when you combine them, fell heavily into April, saw a good recovery into June. Then we had the shutdown in Victoria, the renewed concerns about coronavirus, bit of a setback. But recently, those indicators are starting to recover again, suggesting the Aussie recovery is back on track. Albeit, you just got to look at that chart, we've still got a long way to go to get back to normal. So a lot of those jobs in my local suburb have come back, but there's areas of the economy which are going to take longer, like travel, like students coming to our universities from overseas, like parts of retailing. It'll take a little bit longer. So if we move on to the next slide, which shows unemployment. Like if you have any doubt that government policies haven't helped there, I think you've just got to look at these numbers. We do a rough calculation on the effective rate of unemployment, and were it not for government activity, government support, JobKeeper particularly, the unemployment rate would have risen to almost 15%, and it would still be about 9.5% in the event we've had unemployment a lot lower than that. So I think there's no doubt that government support has helped. And we've also seen that, for example, in some stats the other day. I think you've read yesterday's Fin Review or the day before, there was a story in there on how people are paying down their home loans faster than normal because they've been stuck at home. So what do? They pay down their home loans. So those things are actually quite positive. And I think that's helped provide a bit of a bridge through the chasm of coronavirus to help us get to the other side. If we move on to the next slide. So these are all feeding into the property outlook. Bunch of things here, obviously a lot of concern. I'm not going to go into the detail on this one. A lot of concern about Australia's high level of public debt now. Obviously with the budget deficit, more tax cuts, all those sorts of things. We heard a lot about that last week. I just wanted to point out that the level of public debt, the bottom right chart there, I think it's going to take a long time to pay that public debt down, if at all, because it took us about a decade after the GFC to get back to budget balance. How long is it going to take this time? So don't expect on public debt coming down anytime soon. In fact, I think the more likely trend, the top left chart, is it goes up. Just bear in mind, though, that the starting point for public debt in Australia compared to other countries, the US, Europe, Japan, is quite low. The other thing is, you might think your mortgage rates are low at, I don't know, whatever the deal you can get, 2.8%, 3%, 3.5%, whatever it is. The government can borrow for 3 years at 0.25%, and they can borrow for 10 years at 0.85%. So their interest costs are next to nothing. So if we move on to the next slide, there will be some lasting impacts from coronavirus. Travel is part of that, and I've got a list on the next slide again of some of those lasting impacts, which I won't go into a lot of detail here, except to point out the very bottom one there. Lower immigration levels. That's going to have a big impact on our property market and what I have to say now. So if we move on from this to the next slide, or just quickly, before I get to property, the US election, that's coming up. There was a lot of concern in markets that if Donald Trump loses, Democrats win, then that will mean higher taxes and more regulation under Democrats, and the share market didn't like that. Now I think there's sort of the market's coming around to this view, well, maybe if Donald Trump wins, yes, we pay higher taxes. Yes, we get more regulation, but we get more stimulus under the Democrats, more support for the economy, and you could argue less in the way of trade disruption with China and Europe and Japan and elsewhere. So the markets are sort of coming around to the view that maybe if the Democrats win, it won't be such a bad thing. Historically, the US share market has done best when there's been a Democrat president and a divided Congress, and it's done second best when there's been a Democrat president and Democrat control of both houses of Congress. So obviously some issues coming up on that front over the next 3 weeks. We'll have to see how that one pans out, but the market doesn't seem too fussed at the moment about a Democrat victory. If we move on to the next slide, which gets to the point about investing at the moment. You know, a lot of investors thought, well, this is a nerve-wracking time. How can I possibly put my money into share markets or anywhere else? Problem is that interest rates are so low. So once the dust settles a little bit, as it has in recent months, as long as you're not in Victoria, people have said, well, I'm only getting 0.7% on my bank deposit, whatever it is, but I'm getting a much higher number out of the share market. So that's seen some of that money go back into the share market. So if we move on again to the next slide, this is my summary view of major asset classes. Not a lot of great returns out of cash. So money has to go somewhere. And obviously, to some degree, it's going towards growth assets. And that is supporting, to some degree, the property market. So I might just jump over that to the next slide again, which relates to property or relates to investing generally. These things, I think, are critically important. It's taking a while to get to property. I've got too many slides. 9 rules for investors to keep in mind. I think as an investor, the first one is the one that's critically important. You have to have a decent exposure to assets that will generate good returns over time to benefit from compounding. Now, if you're investing for 40 years, best way to do that is to have a decent asset that provides a decent return, and those returns will build on top of themselves over time to give you a decent nest egg for when you retire or whatever you use your money for. So that's why you need a decent exposure to shares and growth assets like property over the very long term. But the key is not to get thrown off by the cycle. Try and invest for the long term. Make sure you're diversified and, very importantly, turn down the noise. Very important in times like the present. So we're going to the next slide again, which I think one way of doing that is to watch The Bachelor, The Bachelorette. Now, Bachelorette on tonight, that's one thing to watch. So I sometimes do, I must admit. A bit of entertainment there. Helps me turn down the noise and also put things in perspective. The next slide, I love this slide. People hanging off a rock in Brazil, looks incredibly dangerous. Then you realise what they're doing. Not that unusual. Go to the next slide. It's all a bit of a show. No real risk. So I think it's very important to put what we're seeing around us in perspective and understand, just onto the next slide again, that we have seen things like this before. That shows the history of the Aussie share market back to 1900. We've seen lots of setbacks along the way. And each time we go through one of these, everyone says, this time is different, you know, it's all horrible, we're all ruined. And then you realise it's just another bit of volatility. And I think that's what we're seeing. If we move on to the next slide, so talking about, hopefully I'm getting there, property, what have property markets done? They've had a bit of weakness recently. The high point in the Aussie property market, as measured by CoreLogic, was back in about March or April. And since then, we've seen softness, particularly in Melbourne, for obvious reasons. That's the green line in that chart there that shows the monthly rate of change, but also in Sydney, and of course in the capital city average. Now that masks a lot of divergence around the country. If I go on to the next slide, you can see what I mean. The falls particularly have been concentrated in Sydney and Melbourne. Now this shows just for the September quarter. If you show the June quarter, the other states were softish as well. And of course, Sydney and Melbourne have come down if you add in more if you add in the June quarter. So it has been soft, but some cities like Brisbane, Adelaide, Perth, Hobart, Darwin, Canberra have held up reasonably well. The other part of the country that's held up reasonably well is the regional centres, and there's some good reasons for that. So if we move on to the next slide again, and I'm going to give you a broad overview here. Obviously, it depends on where you are. So my basic view is that average prices around Australia will come off a bit more, probably by about 5%, but it does depend critically on where you are and on what sort of property you're into. Positives are record low mortgage rates. That makes getting into property cheaper than before in terms of servicing your mortgage. And that's partly why people are paying off their debt faster at the moment. Regulatory easing. We saw the government announce 2 or 3 weeks ago removal of the responsible lending obligations on the part of banks, which should speed up the process of getting a loan. And finally, in other words, they may not do all that checking. They may not ask you how much money you spend on coffee, how much money you spend on the gym, that sort of stuff. They may not go into that level of detail. And finally, we're seeing a lot of government support measures for the housing sector. The first home loan deposit scheme and also home builder to get a new home. A lot of that focused on new housing. Of course, there are some negatives in there. Property is still expensive in Australia. There's an oversupply of units in some areas. You look at vacancy rates in Sydney and Melbourne, particularly inner city areas. That's quite problematic. There's a hit to household incomes from highish unemployment. Not as bad as it could have been, but it's still higher than it was. And of course, we've seen that collapse in immigration, and we've got weak rental markets in some cities. If you put all that together, you also got to allow for something called work from home. Like a lot of us at the moment, me included, working from home. And that, of course, changes people's mindsets. If I'm only going into the office, say 2 or 3 days a week, I kind of think, well, maybe I don't need to be as close to the office. And some companies I saw was at Microsoft said all employees could work at home all the time. So then you think, well, why do I need to be even near the city? I could be out at Port Macquarie or Geelong, or that's a city in itself, or a regional city or something like that. You don't need to be necessarily near the CBD of Melbourne or Sydney or Perth or whatever it is. So that changes people's mindsets, and suddenly there's increased demand for outer suburbs, regional centres and houses at the expense of inner city areas and units. So that's another big factor going on in all of this. So those cross currents are what's going to be driving the property market over the next year or 2 or 3, probably for several years, I think. If we move on to the next slide, which shows the basic fact that Australian housing is expensive. If you look at the ratio of Australian house prices to income and rents, we're at the high end of comparable or OECD countries. That's the left-hand side chart there. And you can see on the right-hand side there, the ratio of household debt to income has gone up dramatically over the last 3 decades. And of course, with that, there's been a rise in household debt. So they're the big negatives operating in relation to the property market in Australia, the housing market. If we move on again to the next slide, this one. Now, regularly, if I go on Twitter, on the internet, there's usually someone there who's telling me the sky's going to fall, we're all going to be ruined, the property market is going to crash. And those predictions have been made with regularity over the last 15, 20 years. And I won't go through the whole list there. But interestingly, just think about this. About 2 or 3 years ago, the banks told many borrowers you have to switch from interest-only loans to principal and interest loans. A lot of people said, gee whiz, that's going to cause a huge level of defaults. And what did we see? We saw very few defaults. A lot of people made that switch, and you can see, if you want to see the details here, the left-hand slide there shows the percent of housing loans which are interest only versus the percentage which is principal and interest. And you can see there has been a decline in interest only loans in terms of the flow of new loans and also the stock of new loans. So the flow is the blue line and the stock of loans is the red line. But we haven't seen a mass increase in defaults. We didn't see a mass increase in people with distressed sales. Part of that is because interest rates are so low. If I look at the right-hand side chart there, you can see interest servicing costs on people's mortgages as a percent of their income is back to where it was about 20 years ago. And that's because we got record low interest rates. So that's partly why we're not seeing the defaults. The other factor, of course, is income support measures, such as JobKeeper and particularly the bank payment holidays. So if we go on to the next slide, very low interest rates, we know all of that. So I'll go on to the next one again. I don't think I can say much more about that one. So now I'm going to go through some of the negatives. The first one is we've got relatively high unemployment. People have been protected by bank payment holidays, as I've just mentioned, and of course, income support measures. And some of those things are going to come to an end. And then we'll still be left with relatively high unemployment. So that's a bit of a drag. And then you've got this huge hit to immigration. Last week in the budget, week ago now, Tuesday, a week ago, we were told that the level of immigration in Australia was going to go negative. So for many, many years, immigration has been a positive contributor to population growth in Australia. It's been running at around, population growth in total has been running at around 1.5%. So every year the Aussie population expands by 1.5%. And about 1 percentage point of that, or just below, has been comprised of immigration, which is what you see in the blue line on that chart there. But the way things are now, we've got no immigrants coming and some people are leaving. We're going to have, according to the government, negative immigration over the next couple of years. So that's going to be a drag on growth in the economy, much like it was at the end of World War II, the 1930s, and also around the end of, around World War I. So pretty weak population growth. That's going to be a drag going forward. So I've mentioned the positives there, low interest rates, some, depending on where you are, some people switching to the suburbs and houses away from inner city areas and units, and of course regulatory easing. But the negatives are relatively high unemployment, income support measures which will come to an end, and very low immigration. So if we go on to the next slide, which shows some of that again, I mentioned earlier the vacancy rate situation in Melbourne and Sydney. It has increased. In Sydney, it's up now around double what it was just a couple of years ago. So there's a lot of apartments come on the market, and also in Melbourne, the vacancy rate has gone up, although it's not overly high just yet, but it looks like it's still going up. And of course, on the right-hand side chart there, you can see the basic problem. For many years in Australia, we've had very strong population growth. The population's been growing. This is the blue line on that chart. The population's been growing at the rate of about 370,000 people per annum. About 2/3 of that was due to immigration. And of course, the supply of housing, the red line, completions of dwellings, was not keeping up with that. And so it was little wonder for the last 15 years we've had very expensive housing. Now we've got immigration collapsing, and the blue line, population growth, has also collapsed. So what we've got helping the population expand is natural growth. Now people having children and so on. Well, that's all it is basically. And that's going to be a lot weaker. So we're going from a situation from massive population growth to very weak population growth, from something like 1.6% per annum population growth down to about 0.2, 0.3% population growth, and that means less demand for housing. So the question is, how is this all going to impact the property market? If we go over to the next slide, which puts things in some long-term context, and this is, before I sum up, I think this is just worth reflecting on, that, as I mentioned in relation to the share market, we go through bouts of volatility in relation to shares, and then eventually it all settles down. And over long periods of time, we tend to find that it provides pretty good returns relative to, say, an investment in cash or government bonds. And you can say exactly the same thing for the property market. This shows all of those asset classes back to 1926. So if you invest $1 in 1926 in Australian housing, the blue line, Australian shares, the red line, you would have had a pretty good return over the last, since 1926. So pretty massive return over that period there, almost getting on for 100 years. Not so good in bonds and cash, okay, but nowhere near as good. And of course, now we know that interest rates and bond yields are going to be a lot lower, so you get even lower returns out of bonds and cash. So the point is, there's still a role for property in portfolios, even though there are those short-term threats from lower immigration. So if we move on to the next slide, which shows a summary as to how I see things, and this pulls it all together. I think average property prices across Australia, across the capital cities, will fall another 5% out to the middle of next year. before bottoming and starting to rise again as record low interest rates and economic recovery start to really support prices. So that's my overall view. Those falls, I think, are going to be driven by a combination of high unemployment, distressed sales as government and bank support measures come to an end. Weak rents, high vacancy rates, you've got that collapse in immigration. So that means underlying demand for housing will be about 100,000 dwellings less than it normally is. Normally, underlying demand for housing in Australia is about 180,000 dwellings a year. Now it's going to be something like 80,000 dwellings a year. So that's going to be a drag. And you've also got this phenomenon of working from home. Initially, that was driven by the pandemic, and then suddenly people have found, and businesses have found that works, and it's likely to become something of a permanent phenomenon. Even though I don't think I'm going to be at home 5 days a week, it's more likely to be, say, 2 or 3 days, something like that. There'll be some in between number, but I reckon there's also going to be some businesses where they might be working at home 5 days a week. That changes the whole dynamic. For 20 or 30 years, the shift has been towards living in the city and apartments. Now I think demand is shifting back out to the suburbs, back out to regional areas. And that, I think, radically changes things and probably will result in more affordable housing for many Australians. But I would point out that the outlook is very diverse across Australia. I reckon Melbourne is probably the most at risk, given the bigger hit to its economy, followed by Sydney. Both of those cities depend very heavily on immigration. And if you're not going to see that, that's going to be a drag. So I reckon Melbourne has the most downside. Sydney, particularly inner city Sydney, also has quite a bit more downside to go. Flip side, though, is that other cities, I reckon, are going to see price rises. And I'm talking here about, well, you know, Perth, Darwin, they are at the tail end of a massive collapse in property prices since 2014. So they've already had their bust. I reckon they're getting ready to start picking up. Then Adelaide, Brisbane, Hobart, they never really had a boom. I know Hobart did for a couple of years there, but nothing like what Sydney and Melbourne had. And also Canberra supported by the public sector. So those cities, I think, will see reasonable gains in the years ahead. I don't think they'll be booming, but I think they'll do reasonably well. I think you should also allow that outer suburbs of even Sydney and Melbourne will probably do a lot better than the inner city areas. And houses in those cities will do better than units. And finally, I would just point out that despite all of these things, despite this, you could argue it's a somewhat confused property outlook, given there's so many conflicting forces at present. At the end of the day, I would still say residential property, just like shares, has a key role to play in an investor's portfolio. So I might leave it there. Hopefully that was the last slide. I reckon we're in for a very entertaining period at the moment with what's going on in the US. I must admit, I often wonder with Donald Trump that maybe 4 years ago he spent too much time watching Saturday Night Live and concluded that he can send up himself better than Alec Baldwin can do it in sending up Donald Trump. So maybe that's what he's trying to do. It does seem like he's gone into self-parody in recent times. But anyway, that's causing a lot of uncertainty. I reckon one of the key things as investors, whether it's in property, whether it's in shares, is to try and turn down that noise. Focus on the long term. Focus where there is long-term value in particular. And of course, this environment we're going through lately has been very, very noisy. So I might leave it there. I hope that's been of some value. I know the property market situation has been somewhat confusing lately. Some people say it's going to crash. That long thought of crash is coming, and then of course now it looks like it hasn't come down as much. Even I've been surprised at the resilience of it, but I think a lot of that owes to the government support measures that have come through, but that hit to immigration is still coming down the line, particularly for Melbourne and Sydney, although the other cities look reasonably well. So I might leave it there and open it up for questions. I think that was the last slide. We could just check. I'm pretty sure it was. So I'll just open it up for questions. It was. There we go, the disclaimer again.
All right, great. Thanks so much, Shane. You know, one of the reasons why AMP puts a lot of focus into debt is because consumers have told us consistently that their home and their investment properties are really important to them to build out their finances. So it's great to see that the market is going to hold, albeit some small decline expected. We've got lots of good questions. I'm going to start with a couple on the economy as they came in at the beginning there, and then move to some on property. So the first one was around, so is there an incentive for the RBA to move to negative interest rates?
There is, and that's because other central banks might do it. Of course, we already have negative interest rates in Japan and Europe. The Central Bank in New Zealand, the RBNZ, Reserve Bank of New Zealand, the Reserve Bank of the UK, the Bank of England, the Bank of Canada. Looks like the holdouts were the Anglo central banks. They're all talking about negative interest rates now. The Fed isn't. But yeah, you do kind of wonder if these other central banks move in that direction as well, then the Reserve Bank might. I mean, so far as things go, the Reserve Bank says, well, there's not a lot of evidence that negative interest rates work. And the Reserve Bank Governor, Philip Lowe, has said repeatedly that he thinks it's extraordinarily unlikely they'll go to negative interest rates. So I'm taking him at his word on that front, that he may have to change, but I would tend to agree that I don't think negative interest rates work. There's not a lot of evidence it's worked in Japan and Europe, so I think it would be silly to go down that path. I think if they have to ease further, and they probably will, first step is to take the short-term interest rate to say 0.1%. That's probably it. And then undertake more buying of government bonds via a process called quantitative easing, rather than go down the path of negative interest rates. One of the reasons I don't like negative interest rates is I think it just confuses people. And I reckon it would really threaten the banking system if you're told that if you want to put your money in a bank, you have to pay the bank for the privilege of doing that. I don't think that helps anybody.
Yeah, thanks. Okay, and you touched on that you thought that one of the reasons why Australia would do well was the fact that we had good resources and trade with China. But the question has been asked, how much do you think we'll be able to recover without needing to lean on the rest of the world, and importantly, America and China? So I think you mentioned China, but what about the rest of the world?
Yeah, that's a good question. At the moment, our exports and imports are flowing. We're consuming a lot of things that are imported, and obviously our exports are still flowing. So we are benefiting from that. What is missing, of course, is the flow of people, both tourists and on the education front. Believe it or not, I'm not worried about tourism. And this is because Australia loses more money from Australians going overseas on holiday every year, as opposed to foreigners coming to Australia. In fact, it's a 1% deficit normally. And so if all these Australians are sort of stuck in Australia and you have to spend your money in Australia, it actually benefits Australia. So as long as tourism stays closed, it's not a big drag on the economy, but higher education, that is a big drag. And I must admit our university system is really struggling at present. The higher education is about 2% surplus of GDP in Australia. So in other words, we export more than we import on higher education, and so not having those students come is a big drag. Ultimately, but it's about 2% of GDP. So if you think about the hit to the economy from shutting down, probably the low point was about 10%. The low point was in the middle of April. We've recovered, I reckon, about 70 or 80% of that hit. So we're still 2 or 3% down from the high point in the economy. Now that's still a deep recession in Australia. 2 or 3% down from the high point is still in recession. So we've still got a long way to go to recover. But that final part will take a lot longer, simply because it's going to take a while to get students back here to our universities. And also, I have to admit that having people fly into and out of Australia does add a degree of dynamism to the country that is missing when you're all closed up. So that's why I think ultimately we do need to get it back, but it doesn't stop the bulk of the recovery from occurring, as we've seen in New South Wales and Queensland and other Western Australia and other states. Most of you would be sort of going about your lives not quite normal, but almost normal.
Yeah, it's amazing. A lot of the research we've seen has shown that there's been a massive shift towards digital engagement as a result of people, through necessity, having to use tools like Zoom and Teams. It'd be interesting to see what that does to the education market, and particularly for Australia, who can potentially get access to a global market. So I understand the immigration and the movement of people, but it'd be really interesting to see how that one plays out. It
will be. It's like we've had 10 years worth of structural change in the economy in 6 months. I've never used webinars to the degree I have lately. I didn't even use Teams before March. I've never used Zoom before March, but now we've all become expert at it, and we realise it's quite powerful. So that's sort of elevated the use of IT up to a whole new plane, which will radically transform things for the better. but also it's going to have some lasting impact. Companies will say, well, maybe you don't need to go on that trip you were planning to make for business purposes to the US. And so I can see tourists flying back and forth again once a vaccine comes along, or we get the thing under control by whatever means, but it may take longer for a lot of the other stuff to come back, if it comes back at all.
I'm going to join two questions here and then move to property. So first question was on what's your thoughts on the impact of Brexit on the global economy? And then the kind of an aligned question is, do you think the WA exit would then ever happen?
I don't think the WA exit will ever happen. I know WA will talk about it, and they often refer disparagingly to people back east, but I think we're joined at the hip there, and that's not going to happen. When I go to WA, I feel very much like I'm in Australia, whereas if you go to the UK, it often does feel quite a lot different to Europe. So I think there's a very different situation there. In the case of the UK and Europe, the risks have gone up. I thought they would have come to a trade deal by now. It makes sense. Europe has far less to lose here than the UK does. Out of interest, something like 45% of UK exports go to the rest of the EU, but only about 6 or 7% of European exports go to the UK. So it's going to be a much bigger impact on the UK, particularly for like the financial centre of London. That's going to be really hard hit. A lot of businesses will relocate to other parts of Europe to make sure they still have that access, which will impact jobs in the UK. The reason Boris Johnson is not so concerned about it at the moment is that the UK economy has already been massively hit by coronavirus, and you could argue that the extra hit coming from a hard Brexit, i.e. exiting without a deal, would be lost in the context of the hit they're already going through from coronavirus. So therefore, what's to lose? Let's just bite the bullet and do it. But I think if they do it, I don't see it causing major ramifications globally. I think it would be a minor issue for the rest of Europe. The rest of Europe seems to be heading towards more Europe. On that point of long-term implications I had a chart there, and I only talked about immigration. There was a line in there that says more Europe. If you think about Europe, every time they have a crisis, they come out of it closer together. Initially, they seem to be flying off, but then they come out of it closer together. Now they're issuing common bonds, which is a move towards having a common government with common fiscal policies. So they seem to be getting closer, and of course the UK won't benefit from that. So it'll be a big negative for the UK, but I don't think it will have the global ramifications that people once feared back 4 years ago.
Okay, I better get on some property questions. So a question here from someone living in Melbourne, one of our clients living in Melbourne, asking about the most appropriate time to invest and what sort of property would be good to invest in. I think you touched on some of this in your presentation, but it'd be good to get a bit of a summary on your thoughts on the future of property.
As to the best time to invest, that's always a difficult one. We often say it's time in, not timing. And I reckon if you invest in Australian property and take a 20-year view, you'll do okay, even if you get in now. But I would probably, given what I've said, I'd be a little bit concerned about Melbourne. I'd be a little bit more concerned about inner city areas of Melbourne and units. I think the trend will be towards outer suburbs, particularly tree change and sea change suburbs, if you can mix the two. And I'd probably also have a bias towards houses. And I'd probably also favour regional centres where you can get a higher upfront yield. I'm talking about investing, I'm not talking about where you live, but you can get a higher upfront yield in a regional centre. And I think rental property in those areas will also be in demand because of the escape from the city. So that's where I would go. But yeah, trying to time that perfectly is always going to be hard. We've got record low interest rates at the moment. It's not a bad time to borrow and then try and pay down your debt as rapidly as you can.
Yeah, I think you mentioned this as well. You sort of said that Perth and Darwin were coming off low cycles and Hobart had never had a growth. And there's a question here on Brisbane. So what's your thought on the Brisbane market?
Well, yeah, Brisbane's an interesting one. I remember for years people would ask me, which city do you think will do best this year? And I would say Brisbane. And then of course we'd go through another year of lackluster property growth in Brisbane or no property growth. And there was always something there. But I reckon Brisbane will deal pretty well out of this. As I said before, it hasn't had a boom So it didn't have that huge run up that Sydney had into 2017 and Melbourne had into 2017. Supply situation up there is reasonable. There was a chart there with vacancy rates. The vacancy factor in Brisbane is reasonably good. It's not as dependent on immigration. I think it will benefit eventually once the borders are opened up and people will travel north for a holiday. So I reckon Brisbane will do reasonably well.
Yeah, I must admit, you mentioned that trend of people moving to regional centres, and there's no question. Even in my team at AMP, a lot of my team have chosen to move out of inner city into bigger properties, either up or down the coast. So I can totally see the appeal of moving to a hotter climate. Albeit they do drink 4x beer, so we'll have to keep some of my beer as we go up there.
Yeah, that's an adjustment for me too, I think. I reckon I could get
there. Next questions. There's always been a lot of talk about first home buyers and the struggle over the years for them to enter the market. Do you think that the lowering of immigration and some of these market forces will help some of those younger generations get into that market?
I hope so, and I think so. And I did write a note on this a few months back now. There's three things that I think will help first home buyers. One is, if you've got a higher level of unemployment, then that means, a bit less competition, maybe some distressed sales, which then provides more opportunity for first home buyers to get in. Secondly, the reduction in immigration means less competition. First home buyers were squeezed out over the last few years as we had this massive flow of immigrants every year, 240,000 immigrants coming to the country. That overwhelmed the poor first home buyer. And finally, the escape from the city. I'm thinking there's an ABC program called that, I think. I watch it regularly. But anyway, that gets supercharged in this environment. I don't think inner city, I should say here, I don't think inner city areas are going to become like Detroit, where if you park your car, you're worried someone's going to steal your wheels or something, like happened in Detroit in 1968. But I don't think it's going to be as bad as that. But I do think we are seeing this shift, the work from home option. The fact that you and I are communicating, you and everybody else here are communicating this way in such with a reasonable degree of reliability. I should say, touch wood, the damn system might go down now if I get too optimistic. But that suggests that you can live more remotely. But anyway, the effect of that is that it gives first home buyers better choices. If there's a whole bunch of people, if their job permits, they can go to more remote locations. Alternatively, if existing workers are all escaping the city, then maybe they'll find some bargains closer to the city. And finally, the government is also providing a high degree of support for first home buyers. So that's probably the fourth reason you can add to that. We've got the stamp duty concessions, we've got home builder, and now we've got the first home loan deposit scheme. So all of those things, I think, are making it a lot easier for first home buyers to get into the market.
Yeah, there's a good relevant question just to that point that I sort of asked that given the diversity there is in the property market across the Australian landscape, are those national policies the right way to do it, or would we be better looking at something that's more state-based or other?
That's a good question, and state governments to some degree will think of that. I guess the federal government down there in Canberra has to set things for the average of Australia, as does the Reserve Bank when they set interest rates. So there's no way to get around that. But I think, there is a role for state governments to go down different paths here. Melbourne and Sydney have different problems to the other cities because they've had traditionally very expensive property. They've now got a potential oversupply of inner city apartments. They're getting a bigger hit from immigration, and arguably that argues for different policies than might be relevant in, say, a Perth, which is at the tail end of a 6-year property bust, or just getting over that property bust. The other thing is here, I think that we also need to think carefully about how quickly we ramp up immigration again. I'm all for immigrants. I think it's made Australia dynamic and helped our growth potential and, better meals down in the local suburbs from restaurants and more variety there. But we also have to allow that the key is to get per capita growth. It's growth in living standards for the people who are already here. So there's that balance. And I think for a while there, we let the balance go too far the other way, and people were getting overly expensive property. We were getting overcrowding, infrastructure which was sort of run down, and not coping. So I think there is an opportunity here, both federally and state levels, to think about ways to better manage immigration going forward, not just ramp it back up to where it used to be and then forget about the consequences of that. There is an opportunity here to permanently, I think, embed more affordable housing in Australia.
Yeah, there's an interesting question here around offshore fixed mortgages that they can be taken for a very long term, like 20 years. So why does Australia have them capped at 5-year fixed interest rates?
That's a good question. I think it just reflects something in relation to our banking system and Australian scepticism of long-term loans. When the fixed rate mortgages came to Australia in the early 1990s, they were seen as a way of getting a cheaper interest rate mortgage rate than the 17% or whatever was prevailing at the time. But people got very burnt through that experience. I remember my sister getting in, thinking she got a great deal at 15% or something in the early 1990s. The standard variable mortgage rate was something like 17%, and then suddenly the bottom dropped out of mortgage rates as we became a low interest rate country, and that scarred people to some degree. So even now, I think it's only 15-16% of total mortgages are at fixed rate. The bulk of them are still variable. Australians seem to have a reluctance to commit to longer term mortgages. The other complication is that Australian mortgage rates are set. If you borrow a particular rate, then you have to service that rate. And if you get a better deal somewhere else and you've locked up for 20 years at, say, 3% mortgage rate, and then you find somewhere else can give you 20 years for 2%, then you can't switch without paying the difference out to the bank. Whereas in America, much of America, you can switch. You hear this refinancing going on. So the risk is in America, it's with the bank as opposed to the individual. So I think it's hard to see Australian banks going down that path where you can have a 20-year loan, but if you can get a lower rate, you can just leave. I don't think Australian banks are going to buy into that story. For good reason. It's not viable longer term.
I got 2 more questions, Shane, given we've got like 6 minutes left. So the first one is, there's been property price increases in some areas and losses in other areas, inner city versus regional. Do you think that that's a cyclical thing, or do you think that that could actually be a permanent trend?
I would lean to it being a bit of a permanent trend beyond the cycle. It's something that surprised me, and then I sort of worked out what was happening, and then you get onto it and you work, oh, that's what's happening. But I think there's a cyclical trend which has caused unemployment to go up and caused some financial distress, and that's put some downwards pressure on prices, and that's why average prices across Australia have come down. So that's cyclical, but within that, we're seeing a structural change, which is the work from home phenomenon, which is leading to increased demand for outer suburbs, regional areas and houses, as opposed to units in inner city areas. And I think that's more of a structural change. Obviously, if we get a vaccine, then some people will go back to working in the city, but I don't think it's going to go back to the degree that it went before, where people are there 4 or 5 days a week. I reckon it's going to be some balance in between, and some people will find that they won't be there at all. They'll be out at home all the time. So I think that's more of a structural shift.
Okay, and then I'm going to just wrap up with one question where I'm going to try and bring a few questions together. There's been a lot of questions in the chat around what's the best place to invest, what's the best property type to invest. Given that your point was that over the long term, you can't really go wrong in the property market. One of the challenges that people have is that they're large investments, so it's very hard to diversify by buying a house. Are there other options out there for people who want to get into the property market but not have to buy a property?
That's a good question, and there have been attempts to overcome that. And I know that when I put up that point of 9 keys to successful investing, I had diversify in there, and immediately I'm thinking, well, it's hard to diversify in property. That's true. CoreLogic and RP Data and Rismark a few years ago tried with a property index that you could actually trade with smaller amounts. That was something you could trade basically on the share market. I don't think that worked too well, and I don't know where that's at, but it was a potential way around that. But yeah, there's no easy answer, I guess, apart from buying units as opposed to houses. It is very difficult to diversify in the property market unless you've got a lot of money or are prepared or allowed to take on a lot of debt. So yeah, it does make things more difficult. I've often kind of thought about it, well, as long as I buy a property in a good location, and I know my property, the one I'm sitting in right now, is a big chunk of my overall wealth. And then I've kind of thought to myself, okay, well, I've got my property exposure, it's in a good location, should do well over the long term, but now I've got to have any extra saving I get goes into my super or beyond that in shares and financial assets. So that's the way I've managed to manage it and get a degree of diversification. But yeah, it is hard to diversify in property unless you've got a lot of money.
Thanks, Shane. Like, that's really good advice. I think your point on the long term, you know, and avoid the noise was really relevant. I think if we can find a way to invest in the long term, then we'll all be well and managing that compound interest. Well, that's it today, everybody. Thank you so much for joining. I'd really like to thank you, Dr. Shane Oliver, for your update and for all of you for joining us. Please keep an eye on our newsletter for future webinars, and which we'll be hosting more of these events, and we'll make sure that we keep you updated and informed. Just one final thing, don't forget that AMP is here to help you with your financial needs, and there's many ways that we can help. If you want to speak to one of our home loan specialists, we do have some great rates at the moment. Call us on 1300 534 325 and press 2. Or if there are any general needs of support that you think AMP can help you, then please don't hesitate to contact us on 133 888. That's it for today. I hope you guys have a wonderful afternoon. Thanks again, Shane, and thank you everyone for joining. I hope you guys have a great day.
Thank you, Ed. Thanks everyone. Take care.